Hi, folks. This is Brad Brain, registered financial planner in Fort St. John, British Columbia. And I'm here today with Rob Macdonald, who is a senior mortgage broker with the Pilot Mortgage Group in Vancouver, BC. And Rob, you and I were speaking recently about something in behavioral economics where somebody will pay a lot of attention to potential cost savings on a small purchase. And I did this myself just recently when in our office, our coffee machine broke and we drink a lot of coffee. So we needed a replacement right away. And so I go down to the store, I got a choice of two machines, and I'm almost paralyzed in the aisle trying to make this decision over which coffee maker to buy. I'm trying to read all the details, figure out all the features, and the point is, it's a $10 difference on the purchase price. All right, I spent all of this time trying to make the right decision when it was only a $10 purchase. Because a $10 purchase on a coffee machine, it seems to be a significant amount. Now, the interesting part about where behavioral economics kicks in is if it was a larger purchase, $10 seems to be insignificant. Like, for instance, if I was to buy a car, I wouldn't care, right? If it's a $10 difference from one dealer to the next, it's not enough to budge me. And the interesting part is 10 bucks is 10 bucks, right? Whether you save it on a smaller purchase, on a larger purchase, it's still 10 bucks. But the point though is that often we will spend a disproportionate amount of time looking for cost savings on routine and maybe potentially even insignificant purchases and not pay attention to sometimes substantial cost savings on our big purchases. Now, one of the biggest purchases that we're going to make is, for many people, real estate. And many times we're looking at a mortgage to facilitate that purchase. So right now we are in a time of historic low interest rates. And long story short, there are some significant cost savings potentials. But the interesting part is people might not be paying attention to that. Paying your mortgage becomes something you just get accustomed to, and you could potentially be overlooking some significant cost savings in today's environment.
Yeah, exactly. And part of the reason is that people, they probably don't have the time to spend in it because they're busy driving around town looking for coffee makers.
Right.
Looking for coffee makers or televisions or whatever it might be. It does amaze me. Like, people will drive to 4 or 5 different stores just to save a little bit of money on a retail purchase. But when it comes time to look at their mortgage or even their investments, they spend very little time giving it the attention that it deserves. So, something like your mortgage, what we always tell our clients and what we offer as part of our service when we arrange financing is that we do at least an annual review with all of our clients. We not only update them, monthly through a newsletter or quarterly. If there's big economic news or changes in interest rates, we'll do some special marketing. But we at least get in touch with them by phone or at least by email and just check in to see how things are going. Do they want to have a look and see if there's any savings? And, we're at a time right now where people who were content at their high 2% interest rate, like a 2.89, 2.99% interest rate. We have clients that are saving thousands of dollars by looking at refinancing, breaking that term, paying a penalty, and getting down their mortgage rates down into the low 2s now. So it is an incredible time that we're at.
Yeah, and I think that this is a very important point to reinforce, because I think for a lot of people, the idea of looking at a mortgage that's already in force is going to fly under their radar. And when you think about it, if we can get a little bit of cost savings on a great big amount of money, it's going to translate into real dollars. So while we won't hesitate to try and save 10 bucks on a coffee pot, it's less common perhaps that people will take a good hard look at one of the largest things that they're ever going to do with their money in their lifetime, and that's their mortgage. So Absolutely. Can you show us some examples of what we're talking about here?
Sure. Yeah, this is quite common. So since we came out of the quarantine, and as we're kind of pulling through the COVID pandemic, people are kind of back to normal, and they're back, shopping for real estate again. Our market in Vancouver here has taken off. But what we're busy with quite a bit these days is people calling in just to just to look at optimizing their mortgage, look and see if there is any cost savings that they have. And these are people that might have got their property or they got a new mortgage within the last 2 or 3 years. And I'll just show you a couple examples that are quite typical of what we're looking at. A client came into us. This is kind of a client that I was working on just earlier this week, but they came into us. Mortgage balance was roughly about $300,000. They got their property, or they got their new mortgage back in July 2018, so it's like 2 years old, at a rate of 3.29%, which historically is not a bad rate. But when you look at what their mortgage penalty was for 81.75, and potentially lowering that interest rate by a full percentage point, I mean, the savings are absolutely outstanding. So, you look at this penalty, $300,000, it's an 81.75 penalty. It seems pretty substantial, but when we take this calculation and then we can go over into a mortgage calculator that we have used, and this is basically kind of gives you a demonstration of what the savings are. So, $300,000 mortgage here. They got it 2 years ago, so there's 23 years left in the amortization. And then what these columns do is it compares the current rate, so the fixed rate that they have right now, 3.29. This is the balance at the end of each year. And this column here, the second column, is at a rate of 2.29%. And what you can see is when you add the penalty onto the existing mortgage, then as you go down through the 5-year term here, at about 3 years, all of a sudden you've recovered the penalty that you paid, and then you're just enjoying savings for the remainder 2 years. So even with paying that $8,100 penalty, the balances, as you can see, it's basically $5,000 left at the end of 5 years, $5,000 less at the end of 5 years. So these are the common things that we look at with clients, and it'll change depending on the lender, depending on where the penalty is, where you are in the term. But these are the common conversations that we have with clients on an annual basis and doing frequently today.
So I think this is really important to reinforce. For one, not everybody's penalty might be $8,000. So, but even if it were to be, even if it were to be something that might appear to be a barrier to proceeding, even building in that, what we have right now is an opportunity to refinance at interest rates that are so low that build it all in. When you're all said and done, you save $5,000 when your mortgage renews 5 years from now.
Yeah, and the examples are if you're at a point in a term where you're just paying a 3-month interest penalty, your savings can even be greater than that. If you want to consider a variable rate mortgage strategy, which is, since the Bank of Canada had lowered the prime rate by 1.5 during the startup of the pandemic, your savings are even compounded on top of that. So there's huge opportunity. It doesn't work for everyone. We have clients come in that the penalty is just too high to overcome, but we give them a plan where we say, okay, right now you're a little too early in the term, but let's check back in about 6 months or 12 months when you get past that next anniversary date, and that might lower the penalty, so it's going to make sense. And hopefully we catch this before rates go up in the future.
Yeah, so worst case scenario, they're already in a pretty good spot right now, and that's fine. They've got a validation that they're in a good spot, but potentially what it means is thousands of dollars of cost savings, really for a little bit of their time.
Absolutely.
Take an hour and potentially save thousands of bucks. That to me makes all the sense in the world.
And at the same time, you can also look, do they have a car loan that, they're paying 4.5% on, and, would it be better to pay, 2.25% on the car loan, credit card debt? There's any number of things. We can look at, also arranging a home equity line of credit at the same time so that they have, that potential emergency fund, which a lot of people have realized with the economic impact that COVID had, that they weren't set up properly to have an emergency fund. Some people can't put that cash aside, but that home equity is a huge asset that they can tap into, but they have to have a tool to tap into it.
Yeah, so basically what we're talking about here is structuring your affairs in the optimal way so that you're able to do the things that you want to do as efficiently as possible.
Yeah, absolutely. I mean, it's a financial plan, and just as you'll sit with clients and you talk about their insurance, their retirement, saving for their kids' educations, what you do with your mortgage and potentially what is probably the largest asset you will have, being your home equity, what you do with that on a long-term basis is key. And, those are the things, if you sat down with the right mortgage broker, the right banker, the right financial planner, those types of questions should get asked. And, you should have an answer for them as a client.
Yeah. Now, that brings us to something that I think is very important and sometimes perhaps gets overlooked, and that's for a lot of people, paying off their mortgage is going to be one of their primary financial objectives. So let's talk about some strategies to pay off your mortgage even quicker than having it just run its course.
Yeah, absolutely. When people talk about their mortgage, basically all they talk about is rate. What interest rate did you get on your mortgage? What, what are you variable or fixed? And, how much discount did your banker give you versus mine? The mortgage rate is just the start of what the conversation is. Obviously you want a decent mortgage rate, but you want that mortgage to fit with what your long-term plans are. And so, as with most of our clients, especially when you talk about first-time home buyers, in the first 5 or 10 years of the mortgage, they may not have the capacity to pay down that mortgage. And in fact, they may get to the point where they need to refinance to do a home renovation or something along those lines. But there always comes a time in a mortgage lifespan that clients will say, now we're at the point where we want to focus on paying it down. And if you're set up with the right mortgage, then you will have lots of options. So, first and foremost, you have those lump sum payments that you can make. So lenders typically will allow 15 to 20% each year of the original balance of the mortgage. And it can be any time, any day, $100 minimum, or sometimes lenders will allow it just on the anniversary date. So it's important to know that term with your lender, how frequently you can make lump sum payments. In addition to the lump sum payment, you can also increase your mortgage payment itself. So again, that's going to be you can increase it by 15 or 20%, depending on the lender. The third one on top of that is a lot of lenders will allow what's called a double up payment. And that's in addition to the other features. And that's where you simply, in our online world, you can just set it up to the next time a payment comes out for the lender to take a second payment. And that just goes straight towards your principal. So, just making those additional little amounts play a huge impact. The easiest one for most people is just simply switch your payment frequency from a monthly payment to a biweekly payment, at least a biweekly accelerated payment. Starting at a 25-year mortgage, just paying biweekly knocks 3 to 4 years off your mortgage right away.
Yeah, and I think for a lot of people, they might be perhaps scared away by big numbers, but even an incremental difference in what you do with your mortgage can have a significant impact in how long it takes to pay off the mortgage and how much interest you're paying along the way.
Absolutely.
We were speaking, I think, the other day about somebody who maybe their payment was like, I'll just, for discussion purposes, let's say it's like 1,900, so then they bump it up to 2,000, and that little bit of difference makes such a big impact on how much they'll pay over the course of their mortgage and how quickly it'll take to be debt free.
Yeah, that client there, actually, we were talking about, they were in a variable rate mortgage, and as most lenders, as they reduce their variable rate, which has come down a percent to like 1.5%, their variable rate mortgage has dropped. They also adjust the monthly payment. So from March into April, they basically saw their payment come down by $100 bi-weekly, so almost $200 a month. So my suggestion to them was just ask the lender to move it back to the original payment that you were paying, which ended up paying an extra $200 a month than what they were set at right now. And that, in the long term, knocked about 3.5 years off their mortgage.
Yeah, it's incredible.
A little adjustment, little strategy, but getting the right advice is key.
Yeah. Now we also spoke about how we want to make sure we got the right mortgage. As you just said, a lot of times people, their focus, it'll go straight to the interest rate. What's the interest rate? But the interest rate doesn't necessarily mean it's the right mortgage for you. Exactly. We want to make sure it's a mortgage that fits your needs. And I've seen this a lot of times in my practice where people, maybe out of habit, they go and grab a 5-year term on their mortgage, even if they know in advance that they're not likely to stay in the house for 5 years.
Exactly.
And then the consequence of that is that they could be stuck with a penalty to get out of the mortgage before the 5-year term unnecessarily, but purely because they made a decision that was not connected to their financial objectives. So is there anything to elaborate on that point about making sure you make decisions that are consistent with your objectives, making sure you get a mortgage that's right for you?
Yeah, absolutely. It's very, very common. Like I would probably, I don't have the exact statistic, but I'd venture to guess that, better than 90% of the mortgages that we get in Canada are 5-year terms. And the vast majority of those are going to be 5-year fixed terms. So when somebody, sees their banker or, calls up the bank and says, what's your rate? 95% of the time that they're going to be quoting a 5-year fixed rate. The reason for that, and it's kind of a mystery in some cases, if you look at CMHC, their statistics say that a mortgage term, the average mortgage term lasts 3.5 years in Canada. So that means something changes. You either decide to move to a different property, you decide that you need to refinance, something else comes up and you basically break that term. So in most cases, if you know your term is going to be between 3 and 4 years, why is everybody defaulting to a 5-year term? And a lot of times it's just because that is what's marketed. Banks make the most money off of a 5-year term. And so it's basically the term that they offer the biggest discounts and the most attraction. So they tie other benefits in with the 5-year term. So, we make a point of asking a client, what's happening in the next 5 years? Do you have any plans to move? Are you thinking of buying an investment property or a recreational property, or maybe it's a home renovation? So if you have anything that's coming up in the next 5 years, maybe a 2 or 3 year term might make more sense, so that your mortgage is coming up for renewal. When it's up for renewal, you can pay it out without penalty, or you'll at least have a small penalty and you won't be dealing with like an interest rate differential. So it's key. It's just knowing, that mortgage is also going to complement what your long-term plan is. If you have kids that are going off to school, you might need to access some home equity sometime in the next 3 to 4 years. So setting that up when you're starting your mortgage or you're renewing your mortgage is one of the key things that we'll focus on.
Just as you're saying that, it struck me that what we're talking about here, it's not just obviously not just the mortgage interest rate, but we're talking about the value of getting professional financial advice.
Yeah.
Yep. That just resonates with me so much. It's one of the things that I speak to all the time, maybe even on a daily basis, is the value of professional financial advice. Great stuff. So there's something that I have an opinion on, but I'd be interested in what you think about this, and that is, how do you see the role of life insurance fitting in with a person's mortgage?
Life insurance is it's one of the pillars of financial planning, and it goes right along with the mortgage, with retirement, with your savings, with everything else that you do. So we're required as mortgage brokers, with our licensing in BC, we're required to offer some form of insurance to a client whenever they get a new mortgage or a line of credit through us. So our product is a group mortgage insurance, life insurance and disability insurance that we can offer. Is it the best product out there? No, it's not. I'm fully aware that it's not, but we do have to offer them something to ensure their wellness against the debt. So sometimes it's a good short-term solution, but typically we always recommend that if they don't have insurance, or if they've had an insurance agent, insurance professional they've spoken with in the past, do go back and visit them, because it is, as the moment that you sign to buy that home, or the moment that you sign for that new mortgage, whatever it might be, your financial picture has had a major change, and you need to make sure that your insurance is also accepting that change. We find far too many clients, you ask them about insurance, and especially in the Lower Mainland here, where the mortgages are so large, they say, oh no, I work for the blah, blah, blah corporation, and I have lots of insurance through work. And if we press them and say, how much insurance do you actually have? Well, it's 1.5 times my salary. Well, your salary is $60,000, so you have $90,000 in insurance, and you just signed for a $400,000 debt. They don't add up. So
Right.
it's important to get it assessed.
Yeah. So I could elaborate on that. I think maybe it'd be uh, perhaps getting into a brand new topic, but when we think about stuff that might appear to be an apples and apples comparison, it's really not. When we look
Mhm.
at what I'll call mortgage insurance, which is an insurance that has your lender as the beneficiary and will pay the mortgage off if something happens to you, versus what I call life insurance, which is insurance on the person, and you get to control the amount, who is the beneficiary, what happens if you change the mortgage. Let's say you change lenders or pay it off early, if you want to look at other insurance needs. And one of the things that this is going to be one of the parts that might seem a little bit esoteric, but it's an important fundamental part, and that is when the policy is underwritten. But I don't think we want to get into the world of post-claim underwriting for this video.
Yeah,
But what I could do to sum
that's a
up
whole
is
other
say that
hour.
with life insurance, which is insurance on the person rather than mortgage insurance, which is insurance for the debt, what you can get is a better product at a better price. So often it makes sense to not just blindly accept the offer of mortgage insurance that comes with the mortgage, but speak to a life insurance professional and make sure that those needs are taken care of as well.
Absolutely.
Mortgage insurance is better than nothing, but that doesn't necessarily mean it's the optimal solution for you.
Yeah, absolutely. And sometimes the mortgage insurance can be really convenient when it's an automatic approval. Essentially, you can sign your mortgage commitment and the life insurance application, and you're walking out the door with insurance. That's one of the key things that we can offer as a benefit. But it's also easily canceled. It's easy to cancel it. So, if you can walk out the door with insurance, great. Work then next day or whenever you can, get in touch with your financial advisor, go through a full insurance assessment, and then most likely you'll be able to put something in place that is better than what we were able to offer. So yeah, totally agree.
I like that.
It's a
Think
huge
of it
component.
maybe as something to fill the gap in between the time when you're looking at buying the mortgage and looking to get in your full financial review.
Yeah, absolutely. Yeah.
Good stuff. Anything else you'd like to add, Rob?
If anything, it's what we just came through with COVID and the quarantines and the economic the economic impacts that we've seen. It's never ever too soon to get you the right advice, both financially, both for your mortgage. So don't let it wait. If we all could look at what happened with COVID and say, you know what, I wish before that came that I had a little bit of time to restructure my finances or refinance my mortgage or set up a home equity line of credit. It's time to do it now. And so get the right advice, get to see a professional, get an emergency fund set up or a home equity line of credit or something along those lines. But don't wait. Don't wait until it's too late. Get it done now, so that you know that you and your family are taken care of.
Yeah, and it's quite easy to get a quick little review of where you're sitting with the mortgage. Really, people would just need to get the information, which is pretty much they can just print out a quick snapshot off the internet,
Yeah, absolutely.
who the lender is, the amount, the interest rate, when it's coming up, how much the payment is. And a person like yourself can use your expertise and experience and draw from that, just that simple snapshot, whether there's some potential to pursue the conversation further.
Yeah, absolutely. Yeah, we do that all day long, and and then happy to arrange phone calls so that we can go through some of the other details about what your 5-year plan looks like that we talked about. And, yeah, it's not difficult to do, and there's potentially thousands of dollars that can be saved.
Yeah,
Especially in today's markets. Like, when you're seeing variable rates getting into like 1.9 range. I mean, we've never seen this before. It's incredible.
right. So very high payoff with not a lot of um, stress and obligation to make the inquiry in the first place.
Absolutely.
That's great stuff. Well, thanks so much for this, Rob. To finish off, I'm Brad Brain. We're speaking with Rob Macdonald. If either of us can be of service, just let us know.
Great. Thanks a lot, Brad.